Tuesday morning. The clock is moving toward 9 a.m., and right now, before the opening bell rings and before the noise of the trading session drowns everything out, there is a window, a narrow, specific, extraordinarily valuable window where the COMEX data sitting in front of you is telling a story about silver supply that most of the market has not yet processed. What you do with that story in the next few minutes before New York opens could be the difference between getting ahead of the move and chasing it after it has already happened. This is your Tuesday COMEX final update. Let's get into it right now because every minute before 9 a.m. counts. Before we get into the specific numbers and what they mean for today's session and the days immediately ahead, let me frame why Tuesday specifically matters in the COMEX silver calendar. Monday is re-entry. The market is shaking off the weekend, repositioning, reacting to whatever geopolitical or macro developments occurred while New York was closed. By Tuesday morning, that initial Monday noise has settled. The positioning adjustments that institutions needed to make coming out of the weekend are largely done. What you are looking at in Tuesday's pre-market COMEX data is therefore a cleaner, more deliberate picture of where serious money is actually sitting, not the reactive Monday shuffling, but the considered Tuesday positioning that tends to persist and drive price direction for the bulk of the trading week. Professional silver traders treat Tuesday morning COMEX data with particular respect for exactly this reason. It is the first genuinely clean read of the week, and this Tuesday the numbers are saying something worth paying very close attention to. Let's start where we always start: registered silver inventories, because everything else in the COMEX data ecosystem flows from this number. Registered silver, the metal formally designated and certified for delivery against futures contracts, is the physical foundation underneath the entire paper silver market. It is what keeps the futures system functioning honestly, and the trend in registered silver inventories over recent sessions has been telling a story that any serious silver investor should find deeply significant. Registered stocks have been trending in a direction that is compressing the ratio between outstanding paper contracts and available physical metal. When that ratio compresses, when the paper to physical ratio rises, meaning there are more paper claims per ounce of registered metal, the market enters a zone of elevated sensitivity. It does not mean a squeeze is imminent today or this week. What it means is that the system has less shock absorption than it did when registered inventories were higher. Any unexpected surge in physical demand, any significant delivery request from a major holder of long futures contracts, any disruption in the flow of metal into COMEX vaults, events that would barely register when inventories are ample become potentially significant price catalysts when registered stocks are lean. Tuesday morning's registered inventory print is therefore not just a number. It is a reading of how much cushion the market has going into the rest of the week, and right now that cushion deserves very careful watching. Now let's layer in the eligible inventory picture, because the relationship between eligible and registered silver is one of the most informative dynamics in the entire COMEX dataset and one of the most misunderstood by retail investors who are just beginning to learn this framework. Eligible silver metal in approved vaults that meets exchange standards but has not been designated for delivery is often described as a potential reserve supply for the registered category, the logic being that eligible silver could theoretically be reclassified to registered status relatively quickly if a vault owner chose to make it available for delivery, and that logic is not wrong. The conversion can happen, but what matters is whether it is actually happening, and at what pace. If eligible inventories are stable or rising while registered is falling, it tells you that vault owners are holding their silver in eligible status deliberately. They are not choosing to make it available for delivery. That is a statement of intent. Metal that could flow into the registered category but is not flowing tells you something about the expectations and preferences of the people who own that metal. They would rather hold it in reserve than commit it to delivery. That reluctance to designate metal for delivery while registered stocks are falling is one of the subtle but powerful supply signals embedded in Tuesday morning's pre-market data. Please go ahead and hit that like button right now and subscribe to this channel if this level of pre-market analysis is what you have been looking for. We do this every single week for the silver and precious metals community, and this is exactly the kind of content that gives retail investors a genuine informational edge before 9 a.m. The open interest picture coming into Tuesday morning adds the next critical layer. What happened to open interest during Monday's session, and how did that change relate to Monday's price action? Run through the framework we have discussed before. Prices up with open interest up, new money entering long bullish conviction signal. Prices up with open interest down, short covering driving the rally, powerful but potentially self-limiting. Prices down with open interest up, new short centering bearish conviction signal. Prices down with open interest down, long liquidation potentially exhausting itself. Whatever combination Monday produced, Tuesday morning's pre-market data updates that picture before a single trade is executed in New York, and the current open interest level itself carries information beyond the directional signal. When total open interest is elevated, when the aggregate notional exposure of all outstanding silver futures contracts is large relative to registered physical inventories, the market is in a state of elevated tension. Not dangerous by itself, but sensitive. Sensitive to delivery demand, sensitive to margin calls, sensitive to unexpected macro developments that force rapid position liquidation. Elevated open interest against lean registered stocks is the specific configuration that has preceded the most violent and rapid silver price events in the historical COMEX data. Knowing whether that configuration is present or absent on Tuesday morning tells you something fundamental about the risk profile of the market you are about to trade in. Let's talk about the warrant cancellation data from overnight, because this is where Tuesday morning can sometimes deliver the most immediately actionable pre-market intelligence. Canceled warrants, remember, these represent physical silver being pulled out of COMEX vaults by owners taking actual delivery, are published in the overnight COMEX inventory report that hits before the New York Open. On most mornings, canceled warrant numbers are modest and unremarkable. Metal comes in, metal goes out, the system functions normally. But on certain Tuesday mornings, and the pattern is not random, it tends to cluster around periods of supply stress or heightened conviction. Among large physical buyers, you see a spike in canceled warrants that is disproportionate to the baseline. When that spike occurs against the backdrop of already lean registered inventories, it is one of the sharpest pre-market signals available to a silver trader. It is not noise, it is signal. Someone with enough resources and conviction to take physical delivery of silver in lots of 5,000 troy ounces per contract, at current prices representing several $100,000 per lot, is choosing to pull real metal out of the system rather than roll their paper position forward. That is not a retail investor. That is not a speculator taking a punt. That is an institutional or commercial participant who has made a deliberate decision that they want the physical metal. Understanding why they might be making that decision, whether it is an industrial user securing supply ahead of anticipated tightness, a large investor expressing a view on the paper to physical ratio, or a foreign buyer arbitraging between COMEX and an overseas physical market, is less important than recognizing the behavior itself. The behavior is the signal. Watch for it in Tuesday's overnight data before anything else. Now let's bring the commitment of traders framework into the Tuesday morning picture, because even though the weekly COT report does not update daily, the most recent reading combined with Monday's price and volume action allows you to make informed inferences about how positioning has likely shifted going into Tuesday. Here is how. To think about it practically, if the most recent COT showed large speculative net long positions that were elevated but not yet at extreme levels, and Monday saw a continuation of the move that has been building those long positions, then Tuesday morning you are looking at a market where speculative momentum is building but has not yet reached the crowded extreme that would represent a contrarian warning. That is a different risk profile than a situation where the COT already showed extreme net long positioning and Monday added further to it. In that case, Tuesday morning's data deserves extra scrutiny because the market may be approaching the kind of one-sided positioning that historically precedes corrections. The COT is a weekly snapshot, but your Tuesday morning analysis is a daily process, and the skill lies in using the weekly framework as a backdrop against which you interpret the daily data flow. There is a specific pattern worth watching for in Tuesday morning's COMEX data that experienced silver traders sometimes call the midweek supply signal, and it emerges from the interaction between registered inventory trends, open interest levels, and the physical delivery calendar. COMEX silver futures have specific delivery periods, and the weeks leading up to first notice day, when holders of long futures contracts can first be required to take delivery, tend to see distinctive behavior in the inventory and warrant data. If Tuesday morning falls within or near that delivery approach window, the registered inventory data becomes even more critical than usual. Longs who intend to take delivery need registered silver to be available. If registered stocks are falling as delivery window approaches, it tells you that available supply is not keeping pace with potential delivery demand, a configuration that puts upward pressure on the spot and nearby futures price as shorts scramble to either find physical metal or buy back their positions. Knowing where you are in the COMEX delivery calendar when you sit down with Tuesday's pre-market data transforms a static inventory reading into a dynamic, time-sensitive signal with immediate trading implications. Let me walk you through how to think about the silver basis and the spread between spot silver and the front-month futures contract, because this pre-market data point carries information that most retail investors never look at and professional traders treat as essential. The basis, the difference between spot silver price and the nearest futures contract, tells you about the relationship between physical and paper markets in real time. When spot silver trades at a discount to futures, a condition called contango, it means the market expects silver to be more valuable in the future than it is today. That is the normal state of affairs in a well-supplied commodity market, where storage costs and financing charges explain the premium for future delivery. But when spot silver begins trading at a premium to futures, a condition called backwardation, something unusual is happening. Backwardation in silver means the market is placing a higher value on silver right now than on silver delivered in the future. It means someone wants physical silver so urgently that they are willing to pay a premium for immediate delivery over forward delivery. Backwardation in silver is rare. When it appears in pre-market data before the Tuesday open, it is one of the most powerful signals of physical tightness in the entire COMEX data toolkit. It is the market itself saying right now, today, physical silver is scarce relative to demand. Watch the basis in Tuesday morning's pre-market data with exactly that level of attention. Let's also address the cross-market context that Tuesday morning COMEX analysis requires, because the COMEX does not exist in isolation. By Tuesday morning in New York, the London silver market has already been trading for several hours. The Shanghai Futures Exchange has completed its overnight session. The premium or discount at which silver is trading in those markets relative to COMEX data that is accessible through financial data platforms before the New York Open tells you about the global physical demand picture in a way that the COMEX data alone cannot. If London silver is trading at a notable premium to COMEX spot, it signals that European and international Buyers are competing actively for physical supply, a demand signal that will put upward pressure on COMEX when New York opens. If Shanghai closed with a significant premium to COMEX overnight, it tells you that Chinese industrial and investment demand is running hot, and given that China is the world's largest silver consumer, that is not a data point to dismiss. Synthesizing COMEX registered inventories, open interest changes, canceled warrant data, basis signals, and cross-market premium information before 9 a.m. Tuesday gives you a genuinely comprehensive picture of the global silver supply and demand balance in real time before the New York session has printed a single trade. Here is the complete Tuesday morning pre-market checklist synthesized into the framework you can execute in under 20 minutes before the opening bell. First, pull the overnight COMEX inventory report, check registered silver against the prior session and the weekly trend, note whether the eligible to registered conversion flow is active or stalled, and scan canceled warrants for any overnight spike. Second, check overnight open interest changes against Monday's price action and categorize the combination using the 4-quadrant framework: new longs, short covering, new shorts, or long liquidation. Third, overlay the most recent caught positioning data and assess whether speculative positioning is at an extreme that represents a contrarian warning or whether there is room for the current directional move to continue. Fourth, check the silver basis spot versus front month futures and note whether the market is in normal contango or showing any signs of backwardation. Fifth, pull London and Shanghai overnight silver price data and calculate whether international markets are trading at a premium or discount to COMEX and in which direction the international demand signal is pointing. 5 data checks, 1 coherent picture, and you are walking into the Tuesday session with more real market intelligence than the vast majority of participants who are about to trade the same market based on far less information. The silver market rewards preparation. It rewards the investor who is sitting with a clear picture of supply, positioning, physical demand signals, and cross-market context before the opening bell rather than reacting to price moves after they have already happened. Tuesday morning COMEX data is one of the cleanest, most information-rich pre-market windows of the entire trading week, and the investors who use it consistently and intelligently are the ones whose silver trading decisions are grounded in actual market intelligence rather than noise and emotion. Leave a comment below right now and tell us which of these pre-market data points you are already tracking and which ones you are going to add to your Tuesday morning routine starting this week. We want to know where this community is in its understanding of COMEX mechanics because your feedback directly shapes the depth and focus of the content we build for you. And if you have a friend or a colleague who trades silver or precious metals and has never heard of registered inventories, warrant cancellations, or the silver basis, share this video with them right now. The 20 minutes they spend watching this could fundamentally change how they approach every single pre-market session going forward. We will see you in the next one.